Last time we spoke with Gary Wagner was before January's non-farm payrolls, which pushed gold prices lower. It's been a volatile week this week. We got Gary with us to make sense of it all. But before we get to that, here's a sneak peek at our BMO coverage next week. And here's Gary. Thanks for being with us today.
My pleasure to be here as always.
So Gary, metals gold prices fell below 1,200 this week following Fed minutes. Popped back up above 1,200 for now, but it's been a volatile week, and we're off the highs that we saw last month. What are you making of gold's actions lately?
You know, it's been really interesting because we do have a push-pull scenario in which we have certain market forces giving some bullish sentiment to gold and some market forces giving bearish sentiment to gold. But it does seem as though the bearish sentiment is outweighing the bullish sentiment as we saw the market dip below that key $1,200 level, and I believe on an intraday basis hit 1198.
Yes, bullish and bearish factors. Glad you brought that up. What do you think is supporting gold right now?
In terms of supporting of the gold market, we have three things that we are looking at very, very closely. The first thing is what is going on with Greece and the European Union. And that, of course, is a dynamic interaction that's still kind of working itself through. Will Greece actually move towards some levels of austerity? Will they leave the EU? And so there's a lot of uncertainty there. The second thing that we're looking at, of course, is the crisis in the Ukraine and some ramping up really of some military action. So we've got those two factors, and then you've got a third factor of ISIS. If you put them all together, you do have some global uncertainty, and I think that is what has been supportive in terms of gold prices.
And on the bearish side, is it really the US dollar that's got gold pegged back?
Well, you have the strength of the U.S. dollar, but you have the equities markets that now have hit another all-time high. As of Thursday, we had an intraday high over 2,100 in the S&P and over 18,000 in the Dow Jones this week. So it's the equities markets along with the U.S. dollar that are providing that bearish pull for gold.
All right, Gary, let's get to your insert and see these key levels and what you brought for us this week.
Well, we're going to talk about really how important this 1198 is, because if you take a look at the move from the lows at 1130 up to the highs at around 1300 and look at the 61% retracement point, that's exactly 1198. Also, chart viewers know from past shows that we've looked at this long-standing resistance line that we drew by going to the tops of the markets. And when the market came down, it actually touched upon that resistance line. And if it breaks through there, that would be breaking through 1198. And that's why it's such a critical area that the market hit this week. And we're going to explore that.
All right, Gary, let's get to it.
Okay. You know, there's absolutely no doubt we have seen gold trade under tremendous pressure over the last couple of weeks, going through various support levels, kind of like a hot knife through butter. The one thing that we do want to realize, and I'm pulling up the Standard & Poor's, this is a E-mini or the Standard & Poor's 500 E-mini, and you can absolutely see that as of Thursday, we hit an intraday high above 2,100 on the Standard & Poor's. And that, along with a strong dollar, has provided some downside pressure and bearish sentiment in the market. The most important thing right now is that I truly feel as though we are absolutely at a crossroads and a critical level in gold on a technical basis. And to kind of point that out, I'm going ahead and I'm pulling up a daily chart. This daily chart is of the spot market of gold. And when we take a look at it, the one thing that we can see is as follows. If we take a look at the most recent rally, the bigger picture, meaning starting from November at around 1130 and trading or taking that up to the intraday high roughly at 1306 and then running different Fibonacci levels, we can see that the level that it is currently at in terms of the low, the intraday low that we hit earlier this week at 1198 is a pretty critical level. It is a 61% retracement, 1197 of this entire move. Also, when we add another fib retracement, and this fib retracement is coming from our secondary point, which is roughly at 1165, up to this top at 1306, we can see that we do have what we call Fibonacci harmonics, in that you have a 76% retracement on this smaller retracement, which corresponds to the 61% retracement at 1197. So the fact that the market came down, tested this area, and very, very quickly, if you can see this single day candle, came off of these lows and closed up near the highs, to me is significant. It is a critical area of support. Now, another way to look at the area that we're in is to take a look at a weekly chart and look at where the market is trading in reference to our long-standing resistance line. Now, this resistance line is created by simply going from the tops of the market, lining them up and carrying it down. It was very, very plain as this market was trading under pressure and was trading in a defined range, meaning 1400 on the high side and on the low side 1160, 1180 in that area, that each time the market would come up to test this particular resistance line, it was unable to do that. That was until recently, because this is that recent low at 1130, but we actually got a breakout above this long-standing resistance line really at the beginning of this year, back in January. And now if we take a look at this, and I'll go ahead and blow this up, you can see that the lows that we have currently seen in the market right here really line up and match that particular area. And so that is the reason that I believe on a technical basis, 1198 is a very, very critical area that we need to see held. If the market manages to find support and bounce off of this, we can still look at a series of higher highs, higher lows, and ascertain that even with this strong correction, we are in an overall bullish trend. However, if we break below this resistance line, we will, on a technical basis, have the real ability to see gold move back into the prevalent bearish sentiment that we have seen over the last few years. There is no doubt, depending on how the market reacts at this particular price point, meaning $1,200 per ounce, will provide us with information that will really be telling us whether or not gold is moving back into an overall bearish trend, not just a correction, which is a 61% retracement from this most recent rise, but rather moving back into the overall bearish sentiment that have been prevalent in this market over the last couple of years. For those that are interested in more information, I recommend that you go to our website, thegoldforecast.com. You'll see a green button here for a free trial. You'll be able to sign up for our free trial and get our daily report all next week. Again, gold at a crossroads at a critical point.
Thanks, Gary.
Look forward to seeing you real soon. Bye-bye.
And thank you for watching this edition of Chart This. Before we let you go, it's going to be a busy couple weeks for Kitco News. 3 shows coming up, starting with Gold Stock Analyst Investor Day in Florida. That starts on Sunday, and then it switches right into the BMO Global Metals and Mining Conference the following few days, and then it's the PDAC. Stay tuned for all that coverage. Have a great weekend.